My name is Darren Wagner, and I am the founder of Morpheus Trading Group, which I created back in 2002. I've also written 4 books on my trading strategy back in the 2000s. My trading books were about ETFs, which at one time was my main focus, but I've broadened that since then to focus on stocks and also crypto. We have a crypto service and a crypto chat room that I actually run. And I'm excited to share with you today some of the great things I've learned about how to survive in a bear market. Not only survive, but how to stay safe and even profit in a bear market. And that's what I want to share with you today. First, we're going to talk about risk management. We're going to talk about one of the most important things in a bear market is controlling your risks. Now, of course, that's important in any market condition, but it becomes especially crucial and critical in bear markets. And that's why we're going to spend some time on risk management. We're going to teach you how to automatically limit your risk through proper position sizing. That's something that a lot of people don't put much thought into, especially if you're new, but it's really crucial. We're going to talk about 5 top ways to control your risk in a bearish market as well. Then we're going to dive into talking about relative strength trading, which is one of the key aspects of the Morpheus trading strategy. We'll talk about what relative strength is and show you a couple chart examples. And relative strength really works fantastically well. In fact, for our crypto service, the Morpheus Crypto Report, we just closed out today one trade for an 83% gain that we held for 5 days and another one for 47% that we held for about 2 weeks. That despite Bitcoin going down. And that's the power of relative strength trading. And it works the same on the stock market side as well. Then we're going to dive into inverse ETFs. I know a lot about the ETFs. So I'm going to be sharing with you some things that really great ways to get some short exposure, especially if you have an IRA or a retirement account that's not marginable. And then we're going to talk about, most importantly, how to know when the market finds a bottom. You don't want to be taking a bearish stance when the market's actually trying to reverse. So these are the 4 trading methodologies we're going to focus on today. And so let's start by talking about risk management. And we're going to discuss how to limit your risk through properly sizing your positions. And there's a simple formula. Again, no need to worry about writing this down. I'm going to send it to you. But the formula is as follows. The maximum risk per trade divided by your stop distance is the maximum share size. So the idea here is that we want to adjust the share size on each and every trade based upon the volatility of the trade and where our stop is. When I was a new trader, I used to always not know any better, and I would just take the same number of shares of every trade based on a dollar value, say $5,000 or $10,000, and I didn't have any type of formula that I used. And what I found was happening is sometimes my winning trades would be smaller than my losing trades would be much bigger, or vice versa, and it wasn't consistent. So when I finally learned this formula and started sharing it with all of our members, it made all the difference in the world. So let's talk about how we calculate this formula. Okay, so first we'll break down each of these: maximum capital risk, stop distance, and the maximum share size. So first of all, calculating your maximum capital risk per trade. How do we do that? Okay, well, first of all, you take the total value of your account size in dollars, and you multiply that times the maximum percentage risk per trade. In other words, the most that you want to risk per trade. Now, you notice I say here from 0.5% to 2%. What that number means is that if you stop out, the trade hits your stop and you lose on the trade, that's the amount of the total value of your account that you will lose. So for example, if you have a $10,000 account, a 1% stop would be $100, right? That would mean that you wouldn't want to lose more than $100 if you have a $10,000 account on any one trade. That would be 1%. 2% it would obviously be $200, and 0.5% would be $50. Now, what determines whether you risk 0.5% or 2%? That's really a personal matter of your risk parameters and how comfortable you are with risk, because everybody's different. But if you're new, I recommend starting near the 0.5% level. Don't take a lot of risk when you're learning. You can slowly increase your risk as you become more comfortable with a winning trading strategy, but start low. So using some real numbers here, again, as I mentioned, $10,000, if you're risking 1%, it's $100 maximum risk per trade. So now we have to calculate the stop distance. So to calculate stop distance, we take the price that we're getting in the trade, the entry price, and we subtract from that what our stop price is. So with every trade you enter, you should always have a stop in mind before you get in the trade. So you always want to plan your trades out in advance to make sure if things don't go the way you planned, that you know exactly where you're going to get out. with the Wagner Daily report that we've been writing for the past 20 years, we actually list our stop prices for every trade that we call in advance. So let's say, for example, you're buying a stock at $50, just for easy math. And you know that if the trade goes down to $48, it's broken support, for example, and you need to get out. It hits your stop. So that means you have a 2-point stop. $50 minus 48 is obviously 2. So it's a 2-point stop. So now the last part of the equation is calculating the maximum share size by these two numbers, the capital risk per trade and the stop distance. So let's put it all together. You take your maximum capital risk and divide it by your stop distance, and that's going to tell you how many shares you can take of each individual trade. So using the examples we've listed here, let's say that you're risking 1% per trade and you have a $10,000 account. That means you're risking $100 maximum risk per trade. And if our stop is 2 points, we take $100 and we divide it by 2 points, and that means we take 50 shares maximum. So what that tells us is that if we take this trade, we take 50 shares and we stop out, no matter what, we're only losing $100. We're losing 1%. We're controlling our risk and limiting our risk and making a fixed risk for each and every trade. So no matter how volatile the stock is, whether it moves all over the place each day or it barely moves, you're going to have a consistent risk by following this simple formula. Memorize this formula. It's quite a simple formula once you understand what the numbers mean. And never stray based on feeling. I know when I was a new trader, it's really tempting. You say, well, this has great news behind it. They're going to have good earnings and everybody's talking about it. And I'm going to, really be aggressive in this. And you risk more than you should. And of course, inevitably, that's the one trade that doesn't work. So what we try to do is we try to remove the guesswork from our trading by having fixed rules that are proven to work. So never stray based on your feeling. Always follow this formula. And as I mentioned earlier, we do all the heavy lifting for you. If you're a subscriber of the Wagner Daily, we actually list the exact position size for all the trades in advance so that we have a model portfolio so that you always know that you're taking the proper share size based on the portfolio. So that's, again, how to limit your risk through proper position sizing, which is a key aspect of risk management, which is especially crucial in a bearish market. Now let's talk about 5 top ways to control the risk when you're in a bearish market. First, which is what we just covered, ensure that you have the proper position size no matter what. That's a golden rule. Always have proper position sizing. Don't guess, and follow that formula that we showed you. Number 2, use mechanical stops to eliminate emotional decisions. Again, this depends on your character, but I know for many people, when you're in the heat of the battle, you're trading sometimes, it's kind of like a war. There's a lot going on and there's a lot of emotions running high when trades are going your way or if they're going against you. Mechanical stops eliminate the emotion from your trading, which again is another key to making your trading strategy objective. So what that means is when you get in a trade, if you get in a trade at $50 and you know in advance your stop's going to be 48, as soon as you get in the trade, get in the habit of setting that stop immediately after you enter the trade. That mechanical stop will remove the emotion from it so that if you're not paying attention or your emotions are running high, you're out of the trade, then you can reassess and decide what to do. Remember, you can always re-enter a trade if the setup is still valid, but this gets you out of the trade and limits your risk. Another key way to control your risk is make sure you shorten your trading time horizon and your expectations for how much profit you're going to make on a trade when you're in a bearish market. So for example, in a bullish market, most of our swing trades, we're swing traders. So we're not day trading and we're not holding stocks for a year at a time. We're what we call intermediate term swing trading. So we generally hold stocks for anywhere from a couple weeks to a couple months in a bull market, with our average profit being anywhere from 20 to 50%, maybe 30 to 50% in a bullish market. That's what we go for in a typical trade. But in a bear market, okay, if we're trading against a trend, for example, on the long side, we're in trades much shorter period of time, several days to several weeks versus several weeks to several months. And likewise, our profit targets are also correspondingly smaller as well. So we're looking to make maybe 10 to 20% on a winning trade in a bearish market versus 30 to 50%. So shorten your trading time horizon and lower your expectations for your profit. It's also key to be out of the market more than you're in the market. Again, when I was a new trader, I thought that if I became a trader and I thought, well, if I'm not trading the market every day, I'm not doing my job, and I'm going to miss opportunities. And what I soon realized is that when I analyzed my trade stats and looked back, I could have taken only about 20% of those trades that I took and made all the money and lost a lot less. So that's Pareto's principle, the 80-20 rule, which you've probably heard of before, definitely applies in trading. So, the idea here is the secret to having a consistently profitable trading strategy in bull and bear markets is to know when to step on the gas pedal, right? You step on the gas pedal when the market conditions are good and everything's in your favor. That's when you're aggressive, you're using all your cash, you're using margin. But when conditions are not favorable, you're either out of the market altogether or you're being very selective. So that really is probably more important than the stocks you pick, just knowing when to be out of the market and when to be in the market. And we have a market timing system we share with our subscribers that lets them know when to be in and when to be out of the market. And I'm going to show you later how well that works with an example. And finally, this kind of goes along with number 4, learn to embrace SOH mode. We often talk about in the chat room, we say, okay, everybody, we're in SOH mode now. That means sitting on your hands. We're not doing anything. We're sitting on the sidelines. We're watching the market. We're making a watch list of stocks to consider with high relative strength, but we're not trading. And learn to embrace that, because cash is a valid position. It's just as valid as being in a stock. So these are the 5 top ways to control your risk in a bearish market. Follow these, and you've already got the bear market in your hands. You got half of it in the bag already if you can just learn to follow these 5 ways to control your risk. So next, let's talk about the second methodology of trading in a bear market, and that is focusing on relative strength trading. What the heck is relative strength trading? All right, well, relative strength is when the price of a stock or a crypto, for example, if you're trading crypto, outperforms the S&P 500 or the Nasdaq. In the case of crypto, we use Bitcoin and Ethereum as our proxies for the market. So a stock with relative strength will decline less than the index on the down days. So if the Nasdaq is down 1%, a stock with relative strength might only be down 0.2%, or it might be flat, it might not be down at all. And the top relative strength stocks are actually going to be up on days when the market is down. Likewise, on days when the index is up, a stock with relative strength is going to be gaining more. So if the Nasdaq is up 1%, a stock with relative strength may be up 5 or 6% on the day. So relative strength works because it simply tells us what institutions are doing, right? When institutions move the market, they control about 80% of the volume every day. So institutions, when they're buying, stocks are going to have relative strength. And if a stock has so much relative strength that it doesn't even go down when the market's down big for the day, what do you think happens when the market eventually is up? That stock becomes the first one to rip higher and often becomes a new leader. So we're continually looking for relative strength. The top relative strength stocks are the ones we focus on. That's really a key secret to our trading strategy is relative strength. It's simple and highly effective. In fact, it's one of the most reliable indicators that we use in our strategy. And this is not to be confused with the RSI indicator, relative strength index. That's slightly different. We're talking about relative strength. Pattern relative strength. In other words, looking at how a stock is performing versus an index, which is different than the RSI indicator. It also works equally well in all trading timeframes. This is the beauty of relative strength trading. So, for example, if you are a day trader, you can look for intraday relative strength using a 5-minute chart, for example, or maybe even a 1-minute chart, depending on your time frame. If you're a swing trader, you use the 4-hour chart or the daily chart. Or if you're a position trader and you hold stocks maybe 6 months to a year, you use weekly charts and daily charts. But the concept works the same no matter what. The relative strength is equally effective on all trading time frames. If you want to learn more about relative strength trading, you can check out our blog later at morpheustrading.com. We've got a great article. I think it's about 4 or 5 articles down. If you scroll down the page on relative strength, it talks more about the relative strength methodology and how it works. Let's look at 2 chart examples to explain, a picture is worth 1,000 words, right? So let's take a look at some charts that explain this concept further. Now, this is a trade we took a while back, and it's a great example, which is why I'm showing this one. A great example of relative strength. It's very easy to see for explaining how it works. So this is back in the beginning of the year, early 2022. In the start of the year, the first couple months, so this is a weekly chart. So each bar you see here is 1 week of price action. So on the top of this chart is DQ, a stock with a ticker called DQ, and on the bottom is the S&P 500 as our benchmark index, right? So in the box here, notice how when the S&P 500 was trending lower on the weekly chart, it was trending lower for like 10 weeks in a row here, where you see my mouse is, the cursor is. And during that same period, though, look at DQ. It was merely moving sideways, not trending lower. So when we spot that, that's our first clue that something is exhibiting relative strength. And then it goes on to our relative strength watch list to look for a potential trade entry and trade setup. So as I mentioned, if something is so strong, a stock is so strong that it doesn't go down when the rest of the market's going down, again, what happens when the market finally bounces? Well, that stock typically becomes the first to show leadership and relative strength. So what happened right here? We got a bounce. We got a 1 week bounce in the S&P, and look what happened. That little bounce took us outside of this box. We broke out above the 3-month trading range. And then again, the S&P 500 sold off, and for about 2 months trended lower and broke down to a new low. This is key. Notice how the S&P 500 broke down to a new swing low. It broke below this low right here. But look what happened to DQ. It merely went sideways and it set a higher low. Notice that? So we set a higher low versus the S&P 500, which set a lower low. So again, with spotting relative strength, we first look for something that's not moving down when the market moves down. And then to confirm that relative strength, we're going to look for higher lows while the market's setting lower lows. And then when we got another bounce in the S&P right here, all we did in the S&P was bounce up just to recover a bit of the range that it sold off. But look what happened here to DQ. It broke out above this downtrend line and started taking off and rallying. All right. And that's again, the beauty. Now you can imagine what happens if the S&P 500 turns up from here and goes higher. This stock's going to continue to show leadership and probably be one of the first to rally to a new 52-week high. So this is a clear example of relative strength and identifying relative strength. Let's fast forward to a current example. This is actually a stock that we're in right now in the Wagner Daily. It's ENPH is the ticker. It's a stock in the solar industry, solar sector. Solar energy sector has been one of the strongest sectors lately, and we've been trading that sector. And take a look here. So again, you're looking at from March on, the S&P 500 has been trending lower. For the first 6 months of 2022, the S&P 500 is in a downtrend. Again, you can see clear downtrend with the S&P 500. But again, what happened? ENPH was setting a higher lows, right? So it set higher lows, and it did set a higher high here when the market bounced, but it actually rallied all the way back up to its prior high. And then it broke out and gapped up above this base of consolidation to a new high, just with a little bounce when the S&P 500 broke out. So the S&P 500 at this point is still below its high from back here, whereas ENPH is well above its high from this level back here. All it took was a reaction to earnings, and it gapped up and started to take off on big volume. This is actually a stock that we're still in, and it's a profitable trade. So we ride the profitable trades as long as the relative strength stays there. So now that you understand what relative strength is, let's talk about how to find relative strength in the top stocks. Okay, the easiest way is to have a stock trading platform that allows you to do charting and do the charts side by side, like I just showed you with the S&P 500 on one chart and the stock on the other. There's a lot of platforms you can do this with. One that we recommend is called TradingView. TradingView has a free version and they have a paid version. The free version is pretty good. You can do this type of charting with TradingView. And in fact, we're currently developing custom indicators for TradingView that use the Morpheus strategy to find relative strength automatically. So that's a work in progress. When that's done, that's going to make it even easier for members to find the relative strength. TradeStation is another popular platform that a lot of people like. I personally like TradeStation a lot. It's a powerful platform as well. Interactive Brokers is another very inexpensive broker for trading, and they have good charting. They have solid charting. Not quite as pretty as TradeStation, but it's effective. Thinkorswim is another popular broker with good charting. You can also use stock scanning software such as TC2000, but that's a little bit more complex and you have to know how to program it. Or once again, our service, the Wagner Daily, we do the heavy lifting because we actually spend many hours every week scanning for relative strength constantly and alerting our members to what has the most relative strength. One of the things that our members get as a bonus is not only do we give them the top trades with the exact entries and exits and access to our chat room, but we also give our members a relative strength watch list, which looks just like this, Basically, it's updated every week where we show the top stocks based on relative strength and a bunch of proprietary parameters that we use that's exclusive to our service. And this is something that we publish once a week, and that's included with the Wagner Daily. It's called a relative strength watch list. And this is to help you find ideas on your own if you want to look for additional trade ideas. Next, let's talk about inverse ETFs. So we've talked about how to manage risk, obviously being one of the biggest things. We've talked about relative strength. And the third way to really optimize your trading for a bear market is by trading inverse ETFs. So first of all, in case you're not familiar or you're new to trading, an ETF is an exchange traded fund, ETF for short. So an ETF, it trades like a stock. You can buy and sell it just like a stock, and it trades on the stock market. But when you buy an ETF, you're actually buying a basket of stocks of a particular sector. So for example, if you buy SMH, that's the ticker symbol for the semiconductor ETF. When you buy SMH, you're not buying just Intel or AMD, you're buying a basket of leading stocks in the semiconductor sector. So ETFs, they're great. There's a lot of great benefits to trading ETFs. You have a bit less risk because you're a basket of stocks versus one individual stock. So ETFs are obviously slower movers than individual stocks, but a lot of people like that depending on your risk parameters. So ETFs, there's regular ETFs and there's inverse ETFs. So an inverse ETF is just like it sounds. It moves inversely to the price of the underlying sector. So for example, if you're trading, let's say SQQQ, that's the inverse ETF for the Nasdaq 100 index. As you may know, QQQ is the ETF that tracks the Nasdaq 100 index. If you buy QQQ, you're basically buying every stock in the Nasdaq 100. If you buy SQQQ, you're buying the Nasdaq 100, but in reverse. Okay, so they're using derivatives to make the ETF move in the opposite direction. So if the Nasdaq goes up 1%, right, SQQQ is going to go down. All right, and if the Nasdaq goes down, SQQQ is going to go up. Right. So not only though are there inverse ETFs, but there's also leveraged ETFs. So SQQQ, for example, is actually leveraged at 2x. So if the Nasdaq is up 1%, then SQQQ is going to be down 2%. Or if the Nasdaq's down 1%, SQQQ is going to be up 2%. So you get leverage on these inverse ETFs, many of these as well. Inverse ETFs are also known as short ETFs. You may hear people refer to inverse ETFs as short ETFs. One of the great benefits of inverse ETFs is that you can get short exposure without a margin account. So if you're trading a margin account, like a normal stock trading account, you can sell short stocks. But a lot of people trade with an IRA, an individual retirement account, and IRAs and other retirement accounts are not marginable. You can only trade in cash. So because they're not marginable, you cannot sell short stocks. So that leaves people with IRA accounts without many options in a down market other than cash, right? Or maybe some commodities exposure. But with short ETFs, the beauty of those is that you can actually buy a short ETF in your IRA account and profit. If the market goes down, you can make profit from the inverse ETF going up, even though you don't have a margin account. And that's one of the best things about inverse ETFs. Currently, there's about 90 different short ETFs. And let's take a look at an example of a short ETF. So this is an inverse ETF called ARK. Some of you may know the ARK investment fund, Kathy Wood's fund, which is ARKK is the stock. Well, there's an ETF called ARK, which is basically the inverse of ARKK. So it's ARKK goes down, ARK goes up. And this was a trade we took earlier this year in ARK. We took this trade in the newsletter, and you can see here it's trending higher. So if ARK is trending higher, that means that the underlying security, ARKK, was actually moving lower. So this is, you flip the chart upside down and you'll see what the inverse ETF looks like. So in this case, we had a bullish base at the highs, right? So we rallied and we started to consolidate and form a base near the highs. So we had a strong advance and then we had a pause, a bit of consolidation here, which is normal after a bullish run. Now, again, we're saying bullish, but this is actually because it's an inverse ETF. So although this is bullish, it's actually the underlying stock was bearish and trending lower and consolidating at the lows, whereas the inverse ETF was consolidating near the highs. So we had here a few weeks rest at the 20-day and the 10-day moving averages. The blue line is the 10-day moving average, and the beige line is the 20-day exponential moving average. We had a couple of weeks of rest. And notice how, as the price consolidated, that the trading range started to tighten up. That's normal. You get a volatility contraction. And when you see price action tightening up after a short-term downtrend line is broken in an inverse ETF. So here we broke this downtrend line. And after the downtrend line is broken, now we wait for the price action to tighten up. And we had what's called an NR7 day. NR7 day means narrow range 7. So it's the narrowest trading range of the previous 7 days. The distance from the intraday low to the intraday high is the narrowest of the past 7 days. So when you see that, when you see an inverse ETF breaks out above a downtrend line and forms an NR7 day, that is your buy signal. That's not your buy signal, but a move above that high the next day is your buy trigger. And in this case, that's exactly what happened. The very next day after this NR7 day was formed, we had an entry with a move above this 2-day high. That was the trigger, which actually sparked ARK on another leg up. And again, this is why we say that on the short side, we're much quicker to take profits, because we had 3 big days up, actually 4 days up, then a gap, and then a big sell-off, which means that we had a rally, right, in the underlying market. So this is a case where we take profits quick. You know, we get a quick move like that and we lock in the gains. When you enter a trade like this, where it's an NR7 trade, nice thing about it is the risk reward is very positive, because your potential profit is much greater than your risk. Because when we take this type of trade setup, we always put our stop either right below the NR7 day or below the 2-day low. Okay, and I believe in this case we had the stop just below the 2-day low. So if you're wrong, you're out pretty quickly, right? But if you're right, you make 3 to 4 times what your risk is in the trade. Okay, so here's just a sample list of inverse ETFs. I'd mentioned that there's about 90 of them out there. This is a list, and we've actually prepared this for you as a nice little file. And at the end of the webinar, I'm going to be sharing this file with you. You'll be able to download it, and you'll have a handy dandy list of inverse ETFs that you can print out and keep handy when you're looking for potential bearish trades in your IRA or other account. So again, I'm going to be sharing this list with you as a file that you can download at the end of the webinar. And the last thing that we want to talk about is how to know when the market actually finds a bottom. I mean, you now know how to control risk, which is the key element of surviving and profiting in a bear market. You know how to use relative strength to find the stocks that are bucking the trend, and even in the market going down, things that are going up. And now you know about inverse ETFs and how great they are for getting short exposure without having to sell short stocks. But all those things are great, but just as markets don't go straight up forever, they also don't go straight down forever. And I know in recent weeks, it's been pretty rough since the Nasdaq broke down below the 50-day moving average. The market's been pretty weak, but you know, it's not going to be like that forever. In fact, when I last looked, we were bouncing today, and eventually we're going to find a significant bottom where it actually starts a new bull market. Now, obviously, we don't know when that is, and we don't try to predict that either, by the way. One of our core methodologies of trading is we don't predict price action, we react to it. Okay, that's that. We trade what we see, not what we think, and that's really key to be objective in your trading. So we're going to talk about, we're going to look at some actual charts of previous bear market bottoms in the Nasdaq, and what were the signals that helped you know it was a bottom. We're going to look at some actual, go back several years here and look at some chart examples, and then we'll finish up by looking at the current snapshot of the market and trying to make some sense of where we might be in the cycle. So the first rule when you're looking for the market to find a bottom is that the index must stop setting lower lows. So if you're looking at the daily chart, if the Nasdaq or the S&P 500 keeps setting a lower low, then you're not at a bottom, right? And we don't bottom fish. We don't try to guess where the bottom is. So the very first thing that has to happen is we have to rally off the bottom, pull back, and then either set a double bottom or set a higher low than the previous swing low. That's the very first thing, most important rule, is that we have to stop setting lower lows. Then once we stop setting lower lows, we look for a follow-through day buy signal. Now, this is actually a term that's from Investors Business Daily. William O'Neill wrote the book, How to Make Money in Stocks. It's a great book. If you haven't read it, definitely should be required reading. But a follow-through day is something that we use also in our trading strategy. So let's talk about what a follow-through day is. So a follow-through day is when the market's in a downtrend. What we're looking for is a buy signal that occurs when we have a 1.5% or more advance rally in the S&P 500 or the Nasdaq on higher volume. Higher volume is the key, because higher volume indicates that institutions like mutual funds and hedge funds and banks are stepping in to support the market. So if the market rallies 1.5% on lighter volume than the previous day, it's not a valid signal. So we need higher volume than the previous day with a gain of 1.5% or more. And a valid follow-through day can occur on day 4 or later of a new rally attempt. So after we've got the first reversal day, we have a reversal day, and that 1.5% advance after reversal day has to be on day 4 or later, which means that it's not follow-through momentum from the first reversal. It's after 4 days or more that the buyers are stepping back in. So that confirms that there is something to it, not just a one-day bounce. If the index, such as the Nasdaq or the S&P 500, sets a new low, a lower low prior to that follow-through day on day 4 or later, then your count starts over, the count for the number of days. So it's invalidated. So again, looking for a reversal. We have a bullish reversal day. And after day 4 or later, we want a 1.5% or more advance. And then we want to make sure we don't set a lower low during that period. Obviously, we want to avoid distribution days. A distribution day is when the market is down on heavier volume than the previous day. That indicates institutional selling. So you don't want to see distribution days too soon after a buy signal. You can have down days, but you want to see down days on lighter volume and the up days on heavier volume. That's a healthy volume pattern in a bull market. And in fact, volume is one of our top indicators along with relative strength. Volume is a great indicator. It never lies because it shows it's the footprint of institutional trading and shows what the institutions are doing. And we also use moving averages, simple moving averages. We look for the index to reclaim the 20-day exponential moving average with the 10-day moving average rising. And a strong uptrend starts whenever the price of an index reclaims the 20-day moving average. So that's the signal that it's time to start getting long when we're back above the 20-day moving average. And if the index holds a 20-day moving average, it's okay to have a one-day shakeout below that, but then we want to see it snap back above that the following day. So we want to stay above the 20-day exponential moving average. So now let's look at some charts to talk about this moving average signal and how that works. Oh, yes, and new leadership and bullish charts should accompany all the above. So when I was a new trader, I used to think that it was important to follow the indexes to determine what the health of the market is, but it's actually not true. Leading stocks lead the market. So in any bull market, you're going to have a handful of stocks that are outperforming the market with major relative strength. And those are the stocks that lead the market higher, not the other way around, not the market leading the stocks higher. So when you're seeing a follow-through day and the market's trying to reverse, you should start to see leadership and clear leadership and bullish charts emerge as well. All right, so let's take a look at the year 2020 Nasdaq bottom. So 2 years ago, we were in a downtrend and we bottomed out right around March of 2020. So let's look at what was happening then. So this was an ideal reversal signal. So if you look at the chart, you'll see that this low marked the low of that 2020 bearish market. And what happened here, first of all, was at this level right here, we saw the price was extended pretty far away from the 20-day exponential moving average. Now, when that happens, you could say it's oversold, although we hate the term oversold because a market can be oversold and remain oversold for a long time. But nevertheless, when the price does get pretty far extended away from this 20-day moving average, it's a signal that we may soon have a reversal, right? Because things are getting stretched a little bit too far to the downside. So after the price got extended far away from the 20-day moving average, within 2 weeks, we had a pop back up to the 20-day moving average. Now notice how the 20-day exponential moving average perfectly acted as resistance 3 times here. Boom, we couldn't get through it. Boom, we couldn't get through it. Here we popped above it intraday, but closed the day below it. So it's very clear that the 20-day exponential moving average is powerful as a resistance level. And then we had a pullback after we couldn't break through. The buyers threw in the towel, and then we had a sell-off. But check this out: the 10-day moving average caught caught the price, right? So this 10-day moving average was already in an uptrend. That's a key, right? So what I mean by an uptrend is it's sloping higher. It's not sloping lower like here. It's sloping higher. And then after 3 days holding at the 10-day moving average, we had a gap up that powered through the 20-day moving average, a definitive, convincing close above the 20-day EMA. This day right here is our buy signal. Right? That's the signal that it's time to start getting long in the market, and it's relatively low risk at this point. So again, we don't want to jump the gun, prematurely here. We wait for the signal of the price getting back above the 20-day moving average with the 10-day moving average sloping higher. And if you look at the chart, you'll see that marked the low and the market continued trending higher from that point. The 20-day exponential moving average was also starting to slope higher. Until that point, it was trending lower. But notice right at that day, that's what marked the turn of the 20-day moving average sloping higher. So you want to see the moving averages sloping higher. The 10-day moving average, as I mentioned, was already sloping higher. All right, let's go back 2 more years. Let's go back to the 2018 Nasdaq bottom. So when we had a downtrend in 2018, this is what it looked like when the market bottomed out. This was a slightly different scenario, but similar. In this case, we got back above the 20-day exponential moving average in just 6 days. So again, we first had the price stretched away from the 20-day moving average, right? And that was one of our signs. But before that, let's go back before that. We saw here when we were in a downtrend, the price popped above the 20-day moving average right here, but it only held above it 2 days and fell apart. Then a few weeks later, popped above the 20-day moving average again, stayed above it 3 days and fell apart. So it failed 2 times. Now, does that mean that we got in when we got above the 20-day moving average and lost money? No, because the signal was not confirmed because the moving averages were not sloping higher, right? The moving averages were still trending lower, and we didn't have a far away extension from the 20-day moving average. So we didn't have all the signals confirming. We only had the price above the 20-day moving average, but without the rest of the signals. So it wasn't until this point down here, right, in December, when the price got stretched far away from the 20-day moving average, and then within 6 days, we're back above it. And here, the difference is, look at the difference here. Now the 10-day moving average is already sloping firmly higher, and the 20-day is already starting to slope higher. And we had previously the price stretched far away from the 20-day EMA. That is our buy signal, and that marked the significant bottom of the 2018 Nasdaq bear. Well, let's go back 2 more years. In 2016. In 2016, we had the price got extended away from the 20-day moving average, and in about 5 days, it popped back above it. So we reclaimed the 20-day moving average, and the 20-day exponential moving average was starting to slope higher. But notice the 10-day simple moving average was still trending flat to slightly lower, right? So we closed above it with a big candle, but we want to wait for the confirmation of the 10-day moving average sloping higher. So a couple of days later, with the price hanging out here at the 20-day exponential moving average, we got a big up day here that pushed us back above the 20-day EMA. And at that point, now we've got confirmation. It held the 10-day MA, and now we've got the 10-day MA 2 days later crossing above the 20-day moving average, which is another bullish signal. And this is our signal here that marked the 2016 Nasdaq bottom. So we were waiting for in this case, we got back above the 20-period moving average pretty quickly, but we had to wait for the 10-day moving average to turn up, to start sloping higher. And finally, let's look at the current situation in the market. All right, so this is as of right before the webinar started. I took this snapshot, so it's pretty current. And this is, well, actually, this was not including today's price action, so it was as of yesterday's close. So let's take a look at where we are and what the market might be up to right now. All right, well, first of all, as you know, we were in a downtrend since the beginning of the year, almost exactly since like January 1st, we've been in a downtrend. Now, on July 19th, we got a buy signal. We got a buy signal because the price, a couple things. First of all, the price closed above the 10, 20, and 50-day moving average, with the 10 and 20-day moving average sloping higher after the price was extended far away from the 20-day MA several weeks prior to that. And we also closed above resistance of the prior swing highs. We formed a higher swing high. So that was our signal that we were forming a short-term low. Now, does that mean it's the end of the bear market? No, but it means we've got a tradable bottom that is relatively low risk, of the market not falling apart as soon as you get in. Now, what's interesting here is those of you who follow our email list and our blog on July 18th, you can actually check our blog and you'll see this post right there. On July 18th, we posted Nasdaq flashes a stealth buy signal. So we actually were on top of this. We notified everybody that was following us that it's time to buy. And that actually marked perfectly the start of the uptrend that lasted about a little over a month and a half. And this was some nice trading here. Once we formed this pattern right here, we pulled back a couple of days later, but held support of the 20-day moving average, right? Perfectly bounced off that. And then for weeks, the 10-day moving average acted as support. And we got a nice tradable bounce there. So we were only on the long side during this period. And then on this day here, we got a gap down below the 10-day moving average. Now, a gap down below the 10-day moving average in and of itself is not that big of a deal. That happens sometimes. But you want to see the price hold the 20-day moving average. Now, again, we mentioned earlier that sometimes you're going to get one day below the 20-day moving average. That also is common. But you want to see the price snap back above it the next day. You want to see the buyer step back in. So we got a warning here, right? And this was August 22nd. We got a warning that the market was below the 20-day EMA. So if it didn't get back above that soon and stay above it, that's a sign that we got to get out of the market. Now, we also, on August 18th, which was a couple of days before this, I think it was right about here, we started seeing some other signals that told us the market was getting kind of heavy. And we published a blog post on August 18th, how to prepare for a stock market pullback now, which is also on our blog, because we started seeing some other signals that we didn't discuss here, that indications that the market was getting heavy. So we actually nailed the bottom of the tradable rally and also when to get out. This is our proprietary market timing system that we share with our subscribers of Morpheus. And it keeps people out of trouble when the market's in a downtrend and helps them make profit when the conditions are right. So after we got the sell warning, 2 days later, we did pop back above, or 3 days later, we popped back above the 20-day EMA. But notice how the 10-day moving average acted as resistance. Price couldn't get back above it. And look what else happened. The 20-day moving average had started to slope lower again, and so did the 10-day EMA. And then we had a big red candle here, right? And we couldn't get above the 10-day moving average. We had the moving averages sloping lower and a big red candle. Time to get out of the market, right? So we're not trying to call bottoms, nor do we try to call tops. We try to take the meat out of the middle, so to speak. So sure, if we're long from this signal up here, we're going to probably have a stop out or two the first day that the market flashes the sell signal. But if you look back at our trading performance over the years, over the past 20 years, you'll see that our system gets us out before the major sell-off starts. So this is the signal right here to get out. And sure enough, after that signal, look what happened. We had basically 6 out of the past 7 days straight down. And now we're below the 50-day moving average. We've got the 10-day moving average has crossed below the 20-day moving average, which is a bearish signal. And now, as of yesterday, the 10-day moving average was about to cross through the 50-day moving average, which is another bearish signal. So right now in the short term, the market's not looking so good. We are trying to bounce today, last I looked. But now this 50-day moving average and the 10-day moving average are going to act as resistance on any rally attempt. So if you're holding anything long and you're wondering where to try to get out, if you get a rally into this 50-day moving average or the 10-day EMA and it starts to stall, that's probably a point to get out in anticipation of another leg down. If we get back above the 20-day EMA, don't jump the gun, right? Wait for the signals that we told you about. Wait for the 20-day moving average to turn higher. Wait for the 10-day moving average to turn higher, and for the price to hold above that. And if you do, then you're going to definitely put the odds in your favor of making sure that you're not prematurely getting in the market. But again, it doesn't matter to us whether the market's trending up or down. And we keep our members out of trouble in a bearish market. We wait for the tradable periods like this. Even in a bear market, you got tradable bounces where we trade on the long side. And then in the meantime, we're mostly cash, or we take the occasional short position. Right now, for example, even with the market being down, we're long ENPH, as I mentioned to you. And even though the market's straight down 6 out of the past 7 days, because ENPH has relative strength, it's trending higher and we're profiting. So that's why I mentioned earlier, relative strength is one of the key elements of trading in a bear market. Here's a few things you can do to learn more. First of all, go to our blog. That blog has literally thousands of articles on great trading strategy articles, actual trades reviews that we walk through. So you can learn a lot of great educational content on our blog. So be sure to check that out. While you're on the blog, you'll see a form for something called MMM, Morpheus Market Minutes. That's a free service we have where we give market analysis and our top trade ideas every day without the detailed entries and exits, just kind of a general sense. But if you're not already a member of the Market Minutes, be sure to sign up for that to keep up to date with what we're doing. You can also follow us on Twitter. We're pretty active on Twitter. We post every day on Twitter with trade setups and analysis and our commentary. We're also on Facebook if you prefer Facebook, facebook.com/Morpheus Trading. The Wagner Daily Pro is really the way, if you're serious about taking your trading to the next level and doing a trading strategy that works. This Wagner Daily Pro has been around for 20 years. So obviously we're doing something right? We've taught this through thousands and thousands of subscribers of the Wagner Daily. We've taught our trading methodology of the Wagner Daily Pro. And the Wagner Daily Pro is a service for swing trading stocks where we send you trade alerts with our exact entries and exits of a trade. So when we get in a trade, we send you a text message to your phone and email. We say we're getting in here. We tell you to stop in advance. We tell you the position size, as I mentioned earlier. We also have a live swing trader chat room that's included. So you actually get access to be able to discuss and talk with everybody. This used to be a separate service. And now, because of our 20-year anniversary push, we've actually included that now with the Wagner Daily service. So you learn a lot. The idea of the chat room, it's not a chat room where people are just rambling nonsense. It's professionally moderated by myself and Rick Petticelli, who's been with me almost since the beginning. So 43 years combined experience in the chat room where we share ideas and education. We post charts, and it's really like a live education every day, just hanging out in the chat room, which is open 24 hours a day. So it's the perfect side hustle. If you've got a day job, for example, you can check in the chat room outside of market hours when you're available and catch up on what you missed. You can even ask questions, and we'll answer your questions later. The next day, you can check in again. In fact, the Wagner Daily service, all of our swing trades are published outside of market hours. It's published every night. So you can actually set your buy orders and your stop orders before you go to work in the daytime. So it really is the perfect side hustle. It's designed to work to complement your existing commitments during the daytime. We have a portfolio, as I mentioned, where we actually tell you the percentage. Remember, we talked about the importance of position sizing. We do that for you. We tell you exactly what percentage of each trade that you want to look at getting in order to keep your risk consistent. If you like what we teach, we certainly appreciate you sharing with your friends or sharing on social media. Thank you very much, everybody. Thanks again. I hope you enjoyed it, and look forward to seeing you at our next webinar and see you in the chat room.